Hello everyone and welcome back to Fun with Fitzy. This is the second video in a series of 3 on the cash flow statement. This video is going to be talking about the steps to prepare the cash flow statement. Okay, unlike other financial statements where you just need the adjusted trial balance or a completed worksheet to complete the balance sheet and the income statement and the statement of owner's equity, you can't do that to prepare a cash flow statement. And the reason is because the cash flow statement needs to basically turn off, I'm going to say, the accrual system of accounting. We need to go back to the cash basis of accounting. And as you know, with accruals, we record our revenue when it is earned and we record our expenses when we incur them, whether or not cash has transferred hands. So what do you need to prepare the cash flow statement? Well, you need 3 things. You need the comparative balance sheet, which means you need a balance sheet that covers, you need this year and last year, which is really the beginning of this year. So you need to see how the accounts have changed over the years. You need a current income statement. And you need some additional information, just like when you're preparing your adjustments at the year end, you need additional information. Well, you need additional information for this as well. So step 1, which makes me laugh every time because I always think it should be the last step of preparing a cash flow statement. But anyways, let's go with it. It says determine the net increase or decrease in cash. So what was cash at the beginning? And what is cash at the end? Did it go up or down, and by how much? That's really all you need to do here. And you're going to look at your balance sheet for that in the current asset section. You're going to look at your cash account. Step 2, well, this is going to be the most difficult step of preparing the cash flow statement. It's a little bit complicated, let's say, but if you follow me, you should be good. So what we need to do here is convert our net income from accrual accounting back to cash-based accounting. And there's 2 ways of doing this: the indirect method, which is used most often, and the direct method. We're just going to learn the indirect method in this course. Okay, so as we've been talking about accrual accounting, with accrual accounting, you record your revenue when you earn it, not when you get paid. And you record your expenses when you incur them, not when you pay for them, basically. So basically you start with your net income and you convert it back to cash. So you wouldn't really include the revenues that you haven't received the cash for, and same with expenses. If you haven't paid for them, they shouldn't be. So you're basically adjusting your net income back to what transferred hands in terms of cash. So in other words, it adjusts your net income for items that affect reported net income but do not affect cash. So we're adjusting it from accrual accounting to cash-based accounting. That sounds a little complicated. This is a little cheat sheet I put together for you. You can find it on my website. It's called Cashflow Cheat Sheet. It has all this information on it. And the top section here is just a review. Remember, there's operating activities, investing activities, and financing activities, and this is where you need to look. So for operating activities, we're going to look at our current assets, not including cash, our current liabilities, and certain income statement items. For the investment activities, we're going to look at changes in investment accounts and changes in fixed asset accounts. For financing activities, we're going to look at changes in long-term liabilities and changes in our equity accounts. And then, of course, there's non-cash activities, which we talked about in the first video, that we won't actually include in the body of the cash flow statement, but we're going to report in the notes to our financial statement. And an example would be to use shares to purchase a capital asset. There's no cash activity there. Really, we're trying to see, is cash going in or out? Is it an inflow or an outflow? And what activity does it affect? Operating, investing, and financing. And we're going to do some activities on this in class. All right, to the bottom of my statement here, in step 1, we're going to look at the current assets. So here we are. We're going to look at current assets, current liabilities, and income statement items. So we're going to go to our comparative balance sheet. We're going to go line by line, starting with accounts receivable. Did it go up or did it go down? And by how much? If it went down, you're going to add it back to your net income. If it went up, you're going to deduct it from net income. This is going to work for all current assets. If they went down, add it back. If they went up, subtract it. And you'll see what I mean when we prepare one. Current liabilities are opposite to that of current assets. If they went up from the beginning of the period to the end, so you're going to look at accounts payable. Let's say it was $10 at the beginning of the period and $100 at the end. Well, it went up by $90, so you're going to add that $90 back to the net income number. And vice versa, if it went down, you're going to subtract it. Amortization and loss on sale of capital assets are expenses that do not affect cash. If you remember, when you record your expense for amortization expense, you credit accumulated amortization. Cash is never affected with amortization. Same with a loss on sale of an asset. So in those cases, we need to add them back to our net income. Let's say the amortization was $1,000 for the period. Well, our net income would have subtracted it as it was an expense. When we were calculating net income, we would have subtracted that expense from revenue. Well, in this case, we're going to add it back because it didn't affect cash. And other revenues or gains on sale of assets, we're going to do the opposite. We're going to subtract them from net income, again, because they didn't affect cash. So this table will come in really handy. I would suggest you write it down and use it when we first practice making the cash flow statement. And again, this is just the operating section of the cash flow statement. Okay, so here's what an example of the operating section of a cash flow statement would look like. We start with who, what, when, as always on any financial statement. And the when is similar to that of an income statement. You record it for the period of, so in this case it was for the year, ended December 31st. And you start off with these headings, cash flows from operating activities. This is section 1. You're going to start with putting net income down in the furthest column on the right. And you're going to get that from your income statement. And then you're going to write adjustments to reconcile net income to net cash provided by operating activities. I will give you this statement in class. And then, as I mentioned, you start going through the current assets, current liabilities, and certain income statement items. So in this case, we'll start with current assets. If they went down, you add, and vice versa here. So there was an increase in accounts receivable by $30,000. And so there you're going to subtract it. These brackets mean negative. There was an increase in inventory. And again, inventory is a current asset. So when a current asset goes up, you subtract it from your net income. So again, put brackets around it to indicate negative. And if these two had gone up, you would do the if they've gone down, you would do the opposite. You would add them back. Then you look at the next section. Again, the next section is current liabilities. So here, there was an increase in accounts payable from the beginning of the period to the end by $15,000. And because there was an increase in a current liability, you add it back to net income. So there we are, adding it back. You can tell it's positive because there's no brackets around it. And again, an increase in accrued expenses. This is like your prepaid rent and things like that. And because it had gone up, you added. If they had gone down, you would subtract them. And then you go through the math here. Negative 30 plus negative 25 plus 15 plus 4,000 equals a negative 36. And then when you add that negative 36 to the 35 of your net income, you end up with a negative outflow of cash. This means if it's negative, it means cash went out. So this company spent $1,000 on operating activities net. So yes, there was money coming in, money going out, but net, there was $1,000 going out. That's an outflow. And again, this is just a partial cash flow statement because it's just the operating activity section. This is what we're going to be doing. After you do step 2, which was determine this cash provided by the operating section, you next go and determine the net cash provided by investing and financing activities. So again, it involves analyzing your comparative balance sheet data and select additional information. You'll need to look some places for that additional information. So for the investing activities, you're going to study your balance sheet to determine changes in investment and long-term assets. If you recall back on my little cheat sheet, we're on this section here, investing activities. You're going to look at investments and long-term assets. And then if there's changes in these assets, for example, in this case, short-term investment, you need to analyze that information to see if there was cash involved. So if you sold some equipment for cash, then you would indicate that as a cash inflow because cash came in. Let's say you purchased some equipment for cash, then that would be a cash outflow. So that's really what happens in the investing activity section. And the financing activity section, again, you're going to study the balance sheet to determine changes in non-current liabilities. So these are the long-term liabilities, and your owner's or shareholder's equity section of your balance sheet. And for these non-current accounts, you're going to see if they went up or down, and you're going to determine whether or not cash was involved. If cash was not involved, then that's not going to be used, and if cash went in or out, then you will use it in these sections. And we're going to actually complete a cash statement in the third video. So let's just take a look at it. We looked at all of the operating section here. Remember, we had a negative 1,000 here, which indicated the company spent $1,000 in operating activities. Now, in this investing activity section, you can see here we have our three headings: cash flows from operating, cash flows from investing, and cash flows from financing. Here, they would have determined that equipment had gone up by $10,000 by looking at the comparative balance sheet, and they would have looked at the additional information, and that would have told them that they spent cash to purchase that. So cash went down $10,000. And that's the only changes that they would have seen in this particular company for the investment activity section. So net cash used, we're going to use the word used if it went down or if we spent money. So in this case, money was going out, you bought equipment. So net cash used by investing activities. Then the cash flows from financing activities here, they issued common shares. And the additional information would have told you that they issued those common shares for cash, and the common shares would have changed on the balance sheet by $60,000. So that would have been an inflow. So that's why the money is going up. And they also paid dividends. And the additional information would have told you that the dividends were $15,000. So because you paid that, the cash was going out. So if it's an inflow, it goes up. If it's an outflow, it goes down. So from the financing activity section, an inflow of 60 minus the outflow of 15 will give you a net cash provided by financing of $45,000. So we're going to start here, and we're going to go negative 1,000 plus negative 10,000 plus 45 equals an increase in cash of $34,000. At the beginning, this company would have had zero cash. I can tell by looking here, the cash balance on January 1st was zero. And cash at the end of the year on their balance sheet, so the cash account would equal $34,000. So here's how you're going to check to see if your cash flow statement balances. If this number you get at the end of all three sections equals the change in cash you had, then you did the right thing. By now, you should know what a cash flow statement looks like, how to read a cash flow statement, so where cash was spent, what type of activities the cash was spent on, or where cash was coming from, and the steps to prepare a cash flow statement. Hope that helps, and we'll see you in the next video.